Breaking news tonight. A massive shockwave has hit the global technology industry as China slaps a 125% tariff on U.S. semiconductor imports, directly targeting companies like Nvidia, Intel, and Qualcomm. Experts warn this could mark the most serious escalation yet in the U.S.-China tech war, raising fears of supply chain chaos, skyrocketing chip prices, and a potential end to American dominance in the semiconductor industry. The announcement came early this morning from Beijing's Ministry of Commerce. In a strongly worded statement, Chinese officials declared that starting immediately, all American-made advanced chips entering China would be hit with a 125% import duty, a move Beijing described as a necessary defense against Washington's economic aggression. This decision follows months of rising tensions after the U.S. imposed sweeping export restrictions on cutting-edge AI chips to China last year, crippling the ability of Chinese firms to access Nvidia's most advanced processors. Washington argued the curbs were necessary to prevent Chinese military use of AI technologies, but Beijing blasted them as economic warfare designed to contain China's rise. Now, China appears to be striking back hard. Analysts say the 125% tariff could cost U.S. chipmakers tens of billions of dollars in lost revenue. Nvidia, which earns nearly a quarter of its sales from China, faces the most immediate risk. Its stock price plunged nearly 12% in pre-market trading, wiping out over $100 billion in market value within hours of the announcement. Intel and Qualcomm also saw shares tumble as investors braced for a prolonged U.S.-China technology standoff. China, the world's largest consumer of semiconductors, imported over $400 billion worth of chips last year alone. By slapping tariffs on American suppliers, Beijing is signaling that it is willing to leverage its massive market power to fight back against U.S. restrictions. At a press conference in Beijing, Commerce Ministry spokesperson Liu Wei said, "If the United States insists on weaponizing technology trade, China will defend its interest with all necessary measures." The era of one-sided technology dependence is over. In Washington, the response was swift but cautious. A White House official called the tariffs an unwelcome escalation, but insisted the U.S. would not back down from its export controls on advanced AI and quantum computing chips. National security will not be compromised, the official told reporters, hinting at potential retaliatory tariffs on Chinese electronics entering the U.S. global markets reacted with panic. The Nasdaq Technology Index fell sharply as traders feared the move could disrupt global supply chains for everything from smartphones to data centers. Tech giants like Apple and Microsoft, heavily reliant on both U.S. chips and Chinese manufacturing, saw shares slide amid fears of soaring production costs. In Silicon Valley, executives held emergency meetings to assess the damage. One Nvidia insider told Bloomberg, "This is the nightmare scenario we've been warning about. If China shuts us out, the entire business model for high-end AI chips could collapse." Meanwhile, Chinese tech firms like Huawei and SMIC, long targets of U.S. sanctions, celebrated the decision. State media hailed the tariffs as a victory for economic sovereignty, framing them as the first step toward reducing reliance on U.S. technology altogether. As news of the tariffs spread, social media in China exploded with nationalist hashtags like #TechIndependence and #China Strikes Back, with millions of users praising Beijing's tough stance against Washington. But behind the online celebration, economists warned the tariffs could backfire, pushing companies to accelerate production in other Asian countries like South Korea, Taiwan, or India, permanently shifting tech supply chains away from China. One thing is clear, the era of calm cooperation in global technology trade is over, replaced by open economic confrontation between the world's two largest economies. The political fallout from Beijing's decision to impose 125% tariffs on U.S. semiconductor imports was immediate and fierce. In Washington, lawmakers accused China of launching an economic counterstrike that could deepen the trade and technology war between the world's two largest economies. Senator Tom Reynolds, a longtime critic of Beijing, called the move an act of economic blackmail, warning that the U.S. must hit back hard or risk losing its technological edge. "This is no longer about trade, it's about global power," he said, urging Congress to expand subsidies for U.S. chipmakers and restrict Chinese access to American financial markets. Democrats struck a more cautious tone, with some calling for urgent diplomatic talks to prevent the crisis from spiraling out of control. Neither side wins in a tech Cold War, said Senator Emily Carter, but the longer this continues, the higher the costs for both economies and for the world. The White House held an emergency meeting with top officials from the Commerce Department, Treasury, and the Pentagon to discuss retaliatory options. While no immediate measures were announced, sources hinted at possible tariffs on Chinese electronics or even tighter export restrictions on critical chip-making equipment. Meanwhile, the economic impact spread like wildfire. Nvidia, Intel, Qualcomm, and AMD all saw their stock prices plunge as traders braced for collapsing sales in China, the largest semiconductor market on the planet. Analysts at Morgan Stanley warned that U.S. chipmakers could lose up to $50 billion annually if the tariffs remain in place. Global supply chains also face new uncertainty. Many American tech firms rely on China not just as a buyer, but as a key part of their manufacturing and assembly network. The tariffs could raise costs for smartphones, data centers, AI systems, and electric vehicles, pushing consumer prices higher worldwide. In Beijing, officials defended the tariffs as a proportional response to U.S. aggression. Chinese state media accused Washington of trying to strangle China's technological future by cutting off access to advanced AI chips and semiconductor equipment. But critics warn Beijing's move could accelerate efforts by U.S. allies to reduce reliance on Chinese manufacturing. Countries like India, Vietnam, and Mexico have already been courting U.S. companies with tax breaks and cheap labor, hoping to lure supply chains away from China. The European Union expressed concern that the U.S.-China tech war could destabilize global markets. EU Trade Commissioner Helena Fisher said, "The world cannot afford a technology iron curtain dividing East and West. This will hurt everyone." Financial markets remain on edge as investors brace for retaliatory measures from Washington, potential countermoves from Beijing, and the possibility of a full-blown technology Cold War reshaping the global economy. As tensions rise, analysts warn this latest escalation could reshape the global technology landscape for decades. The 125% tariffs mark not just a trade dispute, but the opening shots in what some are calling a new technology Cold War between Washington and Beijing. The risks are enormous. Semiconductor supply chains are already highly interconnected, with design centers in the U.S., manufacturing hubs in Taiwan and South Korea, assembly plants in China, and customers spanning every corner of the globe. A full-scale economic confrontation could fragment these networks, raising costs, slowing innovation, and dividing the tech world into rival spheres of influence. One scenario troubling Wall Street is the possibility of dual technology ecosystems emerging, one led by the U.S. and its allies, the other centered on China and the global South. Such a split would mean competing standards for AI, 5G, and next-generation semiconductors, forcing companies and countries to choose sides in a technological arms race. Another risk lies in retaliation by Washington. While U.S. officials have hinted at countermeasures, options are limited. Additional tariffs on Chinese goods could fuel inflation at home, while harsher export controls on chip-making equipment might push Beijing to accelerate its semiconductor self-sufficiency drive, reducing long-term dependence on U.S. technologies altogether. Meanwhile, Chinese tech giants like Huawei, SemiG, and Baidu are expected to benefit from Beijing's push for tech sovereignty. With billions in state subsidies, these firms are likely to develop domestic alternatives to Nvidia's AI chips and Intel's processors, potentially eroding U.S. companies' market share even after the trade war ends. Global markets remain nervous. Hedge funds are increasing bets on gold, rare earth metals, and energy stocks as safe havens, while tech-heavy indexes in the U.S., Europe, and Asia experience sharp volatility. Semiconductor equipment makers in Japan and the Netherlands, key players in the global chip ecosystem, fear being caught in the crossfire if Washington pressures allies to join its export bans. Perhaps the biggest unknown is Taiwan, home to TSMC, the world's most advanced chip manufacturer. Any disruption in U.S.-China relations involving Taiwan could trigger an unprecedented supply chain crisis, crippling industries from smartphones to electric vehicles. Economists warn the tariffs could shave up to 0.5% off global GDP growth if they lead to prolonged trade and technology fragmentation. Developing nations relying on cheap electronics and AI systems could face rising costs, widening the digital divide. As one senior analyst told the Financial Times, the 20th century was defined by the oil wars. The 21st century may be defined by the chip wars. And tonight, with markets trembling and political leaders trading threats, one question looms over Silicon Valley, Wall Street, and Beijing alike. Is this the beginning of a permanent split in the global technology order? Or just the first battle in a much bigger economic war yet to come?